And this is the most important peacetime financial and economic event probably ever. They don't see it coming. Two incredibly smart people, one of whom was totally undone because he just fell in love with his own idea.
Tim Harford is an economist, journalist, and author of books such as How to Make the World Add Up and host of the Cautionary Tales podcast.
I'm not saying the world's simple, but often when you're faced with a complicated world, fairly simple advice works. So people say, oh, in a bear market when the market's falling, then the active funds will beat the index funds. Why? Why is that? I don't understand why that would be. Remind people. You're taking this buzzer out of my cold, dead hands.
You said when I was reading through the research and the briefing that your economics training has given you justified confidence in some areas and humility in others. Can we talk about a couple of the areas where you've had loads of confidence and where you've been humbled?
Yeah, absolutely. I think the great thing about economics is it really gives you the confidence to understand how financial markets work, how financial products work, that there is no such thing as a free lunch. So you don't fall for obvious scams. You're like, if this really was paying 80% a month, why are they selling it to me? All of those things. And I think there's that confidence in numbers, confidence in being able to parse technical claims. But at the same time, studying economics really makes you aware of quite how wrong people can be, in particular economists. Economists can be wrong really badly. I mean, do you mind if I tell you a story about my favourite economist, John Maynard Keynes?
Go for it.
That's my favourite one too now, listening to you.
I'm going to point out, though, that we just gave you a free lunch. So.
Okay. Yeah.
You sat out there and ate that before we recorded.
I didn't pay for the lunch directly, but
your time.
I'm paying
your
for it now.
presence is a present.
I am paying for it now. So there we go. We'll see how high the price is. Irving Fisher, John Maynard Keynes. So Keynes is super famous. If you've ever heard of an economist, John Maynard Keynes is probably the one. Economists still divide themselves up into the Keynesians and whatever it is the other lot call themselves. Irving Fisher was an American economist, about 15 years older than Keynes, and he was the most famous economist on the planet in his day. And he was very active, basically from about 1910 to about 1940. So we're talking between the wars. And what fascinates me about both of these guys is they were amazing academic economists, hugely respected, but they were also rich men. And one of the reasons they were rich is because of their investment savvy. So they were very interested in the idea that by using their economic theories, they could make better forecasts. And by making better forecasts, they could make money. So far, so good. The problem is what happened to them. So over the 1920s, Irving Fisher builds his fortune in the United States on selling his economic statistics and his economic forecasts to the masses. So he's got this newspaper page, it's a syndicated page, Irving Fisher's business page, and it's full of Irving Fisher's insight. And what he's telling people is, and this may sound familiar, America is going through a technology boom. There are these new technologies, they're boosting the productivity of American companies. And at the time, the technologies he's thinking of are electrification, bulk chemical processing, the internal combustion engine. He's basically saying to American consumers, American investors, grab yourself a slice of this, borrow some money, buy shares. And he's doing this in the most public way possible. And for a long time, it works really well. The stock market goes up and up and up and up and up until it doesn't, which is what the stock market does. And there's a crash in 1929. It's still called the Great Crash. It's the most famous financial crisis in history. And the Dow Jones Industrial Average falls 89%. So if you had $100 invested in the market, you've got $11 at the end of it, which is, that's not the kind of crash we normally see in shares today.
And if you borrowed, you're in a real bad place.
Oh, yeah.
People did, yeah.
Yeah, you borrowed $100, put it in the market, lost $89, you've got $11 left, and you owe somebody $100. Yeah. You've got a problem. So that was what happened to Fisher. Fisher, and as I say, he's incredibly well known. So one person blamed the crash on the president, the Treasury Secretary, and Irving Fisher. Like, he's that famous. He, on the front page of the New York Times, 2 weeks before the crash began, he said, stocks have reached a new and permanently high plateau. So it's this incredibly public forecast. And Fisher's basically wiped out by this. completely wiped out. But what interests me is the contrast with Keynes. So Keynes is also interested in investing. I mean, he has an amazing investment. I don't want to get too diverted, but he's got like wartime escapades, destroyers escorting him across the channel to bid in an art auction in Paris, with the German army shelling Paris, in disguise, with the head of the National Gallery. I mean, he's doing crazy.
He was a bit of a rock star, wasn't he?
He was a legend.
He was crazy.
He lived one of those crazy lives.
My favourite quotes you gave me were... one, he said, "This high-risk gambling amuses me."
Yeah, he writes to his father. This win or lose, this high-stakes gambling amuses me.
Legend. And then also, "The only regret in my life is not drinking more champagne."
Exactly.
My kind of guy.
Yeah.
Love him. From that on, I'm like, he's my favourite.
Yeah, and his love life, it wasn't like a 1920s economist. It was like a
star.
1970s rock star. It was, yeah. Anyway, he makes a fortune, he loses a fortune, he makes another fortune. He knows everyone. He's getting phone calls from the Bank of England saying, "Oh, yes, Maynard. Yeah, interest rates going up tomorrow. There's a good chap." So he absolutely knows everything about how the economy works. But his investment strategy is pretty simple. He is going to predict recessions and booms. And he's going to move into the kind of sectors of the market that do well in recessions before there's a recession. So, if you're a bankruptcy lawyer, you're going to do well if there's a recession. So you invest in bankruptcy lawyers. And then when there's going to be a boom, you go to the really, really cyclical stocks that do really, really well when there's a boom. He'll just do that. That's the strategy. And that's going to work brilliantly as long as you can predict when the recessions are going to be. So that's Keynes. And he's doing this at the same time as Fisher's over in America with his business page. Now, Keynes basically makes the same fundamental forecasting error as Fisher. He doesn't see the Wall Street crash coming either. And the Wall Street crash is followed by the Great Depression. I mean, this is the most important peacetime financial and economic event probably ever, certainly for a quarter of a millennia. And these two guys, they're the two best guys in the field. They don't see it coming. But Keynes dies a millionaire.
Yeah.
That's the thing. Fisher, he's wiped out financially. His reputation is destroyed. Keynes, by the end of the Second World War, he is at Bretton Woods, this great hotel. He is working with all the diplomats and the senior economists in the world. They are building the World Bank. They are building the International Monetary Fund. They're building the post-war economic order. And Keynes is right at the heart of it. And at the end of that conference, there's this big banquet. And Keynes is the last man to enter the room, and everyone in the banqueting hall stands up to give him a standing ovation for just for being John Maynard Keynes. He's that famous. He's that successful. So
Damo's dreaming of him. He's like, this is me one day. He's like, I will get there.
But hang on, he made the same mistake as Irving Fisher. So how come he gets all the good stuff? How come he died so rich? And the basic answer is that Keynes changed his mind, and Fisher didn't change his mind. So then you go, well, so what do you mean he changed his mind? Well, he changed his investment strategy. But then you go, well, why did he change his investment strategy, and why did Fisher not? And I think the simple answer is Fisher was telling everybody about his investment strategy. It's on the front page of the New York Times. He's totally associated with it. So he can't back out. Whereas Keynes is doing it in private. He's investing on behalf of a Cambridge college. And actually, by the time the Wall Street crash comes, Keynes is looking at his investment performance and going, this is actually not that great. Just privately, he writes to a friend, I think I'm about 20% behind the market over the last few years. So he's ready to change. He's got that humility. He's got that acknowledgement that he hasn't done a great job. And so when the crash hits, which he didn't forecast, but when it hits, he's ready to move. He's ready to change. So that's part of it. But I think the other is, it's just they were different characters. And I think there's something in this for all of us. And it goes to that quote about win or lose, this high stakes gambling amuses me. He realized there's an element of luck, that investing, it's not gambling actually, but it's not completely controllable either. You can't do what Fisher loved to do, which was to crunch all the numbers, to analyze everything, to look at all the data, to get every angle, and then basically to go, right, I know what's going to happen, because you don't know what's going to happen. And Keynes always acknowledged that. He always acknowledged there was a bit of risk. And if he lost a fortune, he's done it before. Nobody's perfect. So there's this really famous line that actually Keynes never said, but everyone says he said it. And I think they say that because he lived it, which is when the facts change, I changed my opinion. What do you do? And he lived that, but he never had the chance to teach that to Irving Fisher.
I want to get into this changing of opinion because I think it flies in the face of like the common investing strategy today. But first, I want to ask you a question, like a think piece.
Yeah.
If Fisher was right and he hadn't have been wiped out, how would that have changed the world that we have today? You know, the Bretton Woods, the gold standard, Irving Fisher's like view of the world. Yeah. How would he have imprinted a different economy on us?
You've taken that in an unexpected direction. I like that.
I just sit there thinking, what if?
Yeah, no, I think that's fair. So I think we probably still have had Bretton Woods. I don't know if Fisher would have been involved. He had cancer in his later years, but his ideas connecting money and inflation and the price level have been very influential. They're still there. People are still trying to work out, like, if the Federal Reserve or the Bank of England prints a lot of money, creates a lot of money, how exactly does that feed into inflation? How does it feed into the price level? Those are the sorts of questions that Fisher was investigating. I mean, as far as his investment performance is concerned, I think it's just there's a really important lesson there, which is that you can be right about the technology boom, you can be right about the productivity gains, and still be wrong in the long run about the investment strategy. Because Fisher was absolutely right that American industry was transformed. I mean, if you look at the productivity data, I think I'm reaching back to something I haven't read for a long time, but I think productivity was increasing at about 7% a year in American manufacturing in the 1920s, which is crazy. That's like doubling in a decade. Now we're like, oh, if you get to 1% a year, that would be amazing. It's more like 0.5% a year or 0.25% a year, or in the UK, it's 0. So 7% a year is incredible. He was absolutely right. It's just that doesn't necessarily mean that you can pay infinite money for a business, because after all, the businesses, they may be getting more productive, but they're all competing with each other. And when you look back through history, you see this again and again. So the railway bubble, I don't know if you've ever discussed the railway bubble on the show. No?
Maybe not explicitly.
No. So this is 1840s in the UK, and if you'd invested money at the top of the bubble in the very best companies, so like Great Western Railway, not the millions of companies that basically raised a lot of money and then just ran away to the Bahamas with the money, but like an actual proper company that was incredibly well run and that laid track and that ran trains. If you'd invested in Great Western Railway at the peak of the bubble, which was, I think, the late 1840s, I went back and did the maths once a long, long time ago. You would still not have done better than just basically buying treasury bills over the long run until GWR was nationalised after the Second World War.
Be like Amazon in the dot-com bubble in the lost decade.
Yeah, it's
you can back the right horse, but you just wrong race.
Yeah, So it's exactly like saying if you had bought Amazon right at the peak of the dot-com bubble, but actually, if you had bought Amazon at the peak of the dot-com bubble, I think you'd be doing just fine right now
today. But could you have ridden out till 2013?
But the point about the railways is like you could have waited 100 years and you would still not have got your money back.
Long time, yeah.
Because the bubble was that big. But railways did transform the economy. So people were right about the technology. And you see the same thing with .com. I mean, .com was incredibly important. The World Wide Web is important. The internet's important. But that does not mean that you should have put money in pets.com. So these things come again and again. So anyway.
So T, recently we had a conversation with tax expert Dan Needle. And I think one thing that became very apparent is you're going to have a real big crypto tax bill.
I am.
What are you going to do with the money, mate? Where are you going to put it?
I don't know. Like every year tax season comes around and I'm stressing. I'm like, how much is my bill going to be?
I'll tell you how I do it. What's important for me is that money, that tax money, is completely separate to every other bit of money in my life. Because otherwise I start counting it as mine. I start locking it away in the stock market or whatever. So I use a tied instant saver account. That's just attached to my business, and I just put the money in there and keep it in there, and that's solely for the tax.
You can just ping it over to tax man when it's tax time.
I just know it's allocated for, and the stress that takes off me is worth its weight in gold.
Every January I'm stressing.
Check that out, mate. We've got a bit here actually about how you can check it out yourselves. I'll let you read it out because, you're the best at reading.
I mean, I'm the star reader of the show. If you're a sole trader or company owner, check out Tide. New members can get up to 4.22% AER variable for 6 months. I say up to because it depends on how much you deposit in your account. The more you save, the higher the rate.
You can get this deal, plus you can get £100 cash back if you fund your Tide Instant Saver account with £5,000 in the first 30 days. You get that by using the code MAKINGMONEY. Terms and conditions apply. The code is Making Money, all one word, and you'll find the full terms and conditions and all details of the offer in the description below. The variable rate is correct as of the 19th of June, 2025. So Keynes, he was wrong about stuff as well. So I know that he's
an economist. We're all wrong about stuff.
We're going to get into that. But I know that he said that he thought the productivity gains meant that we would enter 15-hour weeks by 2030, he said.
Yeah.
But obviously not, right?
Well, I don't know.
We're still a bit of time.
We've got 5 more years.
I mean, that would be the ultimate if it did. But what it seems to me is that he underestimated the human thing of we like to work. And we find a way to fill the gaps.
So that essay it's called Economic Possibilities for Our Grandchildren. It was written in 1930. So that's why he had this 2030 deadline in mind. He's basically think about what might happen a century hence. You can get it off the internet. I think it's only about 5 pages long. It's really worth reading. He writes really well. So there's an interesting question. So did he get that wrong? Because there is a point of view that basically says the number of hours that we worked on average from 1930 through to the 1970s was absolutely on track, exactly as he predicted. And then in the 1970s, it started to go astray. So there's 2 views of that. One is, well, he was wrong because people basically started to get more competitive. It's a winner-takes-all economy. There's more inequality. You have to be top dog. You've got to get to the top of the pile, and so there's this rat race effect, and so people work harder and harder and harder. That may be part of the story. The other part of the story is, well, in 1970, most people weren't going to university. A lot of people leaving school at 16 or maybe 18, but they weren't going to university, and then they'd work until their late 60s, and then they'd die when they were, 72. So you get 4 years of retirement. I'm exaggerating, but you know what I mean. Whereas now, people are retiring earlier. Although the state pension age has gone up, people on average, I think, are retiring earlier. They're starting work later. And so even if you look at how many hours a week a working person is working, that's not shrunk very much. But if you look at how many hours somebody works over the course of their life, you might go, you know what? Keynes wasn't completely wrong, because we spend so much time either at university, which I guess we could say it's not working. Maybe it's working, or retired. So there's different ways of interpreting what he said.
Or could another one be that the productivity gains have been hoovered up by the owners or of systems rather than shared with the individuals? So
yeah, yep. So that's an interesting question. Oh, well, first of all, is that have there been any productivity gains since the 1970s? We've not done so well, so that's part of it. The real productivity boom was between 1920 and 1970, and then since 1970, it's been a bit disappointing. So that's part of the story. But I think if you try and figure out where the gains have gone, my reading of the evidence, and it's not something, I'm not an expert in this, is that it's mostly gone to people who work, but at the top of the pyramid, top of the heap.
CEOs,
the top lawyers, the top bankers. So not necessarily the bosses, but sometimes the bosses, but people in very highly paid professions. The top YouTubers. Mr. Beast is doing all right, isn't he?
He is.
And is that the owners of capital? I mean, not really. It's more a case of these people are working and they're working hard, but they're getting paid a phenomenal amount for how hard they work. And they realize that if they cut back and said, you know what, I'm making so much money, I only need to work 15 hours a week, like Keynes said, well, they wouldn't be making anything like as much per hour, because they wouldn't be able to sustain that position absolutely at the top of the pyramid. So that's another theory about what's going on. On this subject, there's an amazing study by Claudia Goldin, who's one of the top female economists sadly still one of few female economists. It's a very male-dominated profession. So Claudia Goldin, one of the things she studies labour markets, and one of the things she studies in labour markets is the gender pay gap. And one of the claims she makes is that if you have these kinds of, she calls them greedy jobs. So greedy job is a job where like you've got to work 60, 70, 80, 100 hours a week. And if you're working 35 hours a week, you can't do the job at all. You just can't get ahead at all. And she says that those jobs are, for obvious reasons, because of where the childcare burden tends to fall, the greedy jobs tend to be dominated by men, and the greedy jobs tend to be where the really high...
Investment banking.
Yeah, the investment banking, for example. But she says there are examples of quite high-paid jobs that aren't greedy. They're not super high-paid, but for example, a pharmacist. So pharmacists, you can work 5 hours a week as a pharmacist. You can work 20 hours a week, you can work 50 hours a week. Basically, it's the same pay per hour because it's quite a modular job. And you can just you can sort a pharmacy out so that you've got like one person doing a job, or two people splitting the job, or 5 people splitting the job. And she says loads of women are pharmacists and get very well paid. So it's partly about the job design, and can we design jobs to be less greedy? That might help to fix the gender pay gap. But also, if we had jobs that were less greedy, we might start living in the world John Maynard Keynes imagined, and more of us might be working 15 hours a week because it would be enough.
What about jobs that are less bullshit? To quote, is it David Graeber?
It's David Graeber, yeah.
Yeah, bullshit jobs.
Yeah, so I have to say I'm a bit sceptical about Graeber's theory of bullshit jobs. So the basic idea...
Sorry, what's a bullshit job? Like examples of bullshit jobs.
You got one, mate.
Yeah, I know. Anyone working with you, mate, bloody hell.
You teed that right up, sorry.
It really did, didn't it?
Just look at it closer.
What's an example?
You're reminding me that I forgot before we started to ask you what that was for, but now I know.
Clarification button.
Yeah, clarification. I was about to clarify, but no, we got the button. I prefer the button. So bullshit jobs, according to Graeber, they're basically jobs that everyone knows they don't really add any value. So basically jobs where, I don't know, you got a bunch of people whose job is to create forms and ask other people to fill in the forms, and then some other people whose jobs are to fill in the forms, and no one needs the forms, and everyone could just get on with their lives without the forms. I mean, that's a sort of oversimplification, but it's that sort of idea where you've got people who are sort of inventing regulations and then imposing regulations and then dealing with the regulations and managing the regulations, and actually nobody needs the regulations. And they might be government regulations, but they could be just internal kind of corporate bureaucracy. These things kind of grow up. So that's his theory, that lots and lots of modern jobs are bullshit jobs. So I'm skeptical. The reason I'm skeptical is a real old school piece of classical economics, which is like, if they really didn't have any value, then you would do incredibly well if you set up a business where you just didn't have those jobs, and you didn't have half the organization making work for the other half of the organization. And so I think there'd be such a strong commercial imperative not to have that I suspect those jobs actually do serve more of a purpose than Graeber thought. But it could be wrong. I don't have any direct evidence of that. That's just my instinct. So I don't know if you've ever talked about Amy Edmondson's work. She's amazing. So she's at Harvard Business School. Her book is called The Right Kind of Wrong. And, I'm really interested in things going wrong. I've got a podcast called Cautionary Tales, which is all
Great
about...
podcast.
That was a lovely plug.
Podcast.
That was a seamless plug. That was really good.
I like things going wrong. So Amy's work is great. And when she was first doing her research, she was looking at organizations making mistakes. So, you've got... flight crew on planes, and when do they make mistakes? When do those teams make mistakes? Or you've got a surgical team. When does a surgical team make mistakes? Anyway, she's looking at this data, and she's got this data that are telling her about the performance of a team, just in terms of their attitude, their teamwork. Do they like each other? Is there good sort of levels of understanding? All of these sorts of things that you'd go, yeah, that feels like a good measure of teamwork. And then she was looking at the mistakes that the teams made. And these were surgical teams in hospitals in Boston, Massachusetts. And she's looking at the data, and the data come back, and obviously you'd think, okay, the teams with the better cultures, better communication, better understanding, they're going to make fewer mistakes, right? Obviously. Obviously. No.
I could say why. Maybe they're too comfortable with each other.
No. So she finds the opposite. So she finds that it's the teams that have, terrible cultures that are making the fewest mistakes. Any other guesses?
Is it because they're on top of each other, because they don't trust each other? Like, do you know what I mean? It's like people crash when they're near home because they feel too relaxed.
It's a good guess. That's not the reason.
No.
Any other guesses?
Scared of being wrong.
Yeah, that's closer. Closer.
They don't want to make a mistake because they don't know these people as well, so they're going to judge them more.
They do less work because they're slower, so there's just simply less data points.
I love this puzzle. They're not making fewer mistakes. They're
reporting fewer
mistakes. They're hiding the mistakes.
Better.
Whereas the people who were genuine,
they're just like, I messed up.
Yeah. People who had a good culture where they trusted each other were like, oh yeah, we made that mistake. Patient died, or often it would be, if the patient dies, then probably you have to own up to it. But like, they made a mistake and you fixed it, and thank the surgery took longer. The patient might have side effects or whatever, but like we sort of patched it up. And if it's a bad team, they'd be like, right, no one's ever going to speak of this again.
Someone's sewn a watch into their kidney, and they're like, no, everything's good, nothing happened.
But a good team, they admit their mistakes. So she made popular this idea, psychological safety. So like psychological safety is this idea that you've got a team who are just feel safe going, we screwed up, I screwed up, we need to fix it. But yeah, not every team has that.
Do you need, for people to admit they made a mistake or they screwed up, is it helpful to have a team? Because in one of your cautionary tales about the end of the world, the cult. Sometimes like with Fisher, people don't want to accept when they're wrong, and then they just make excuses for why they were wrong, and then they explain it away.
Yeah, do you want to hear the story? It's an incredible story. So it's this cult in Chicago in, I think, 1953, about then, and they're called the Seekers, and they believe that it's this sort of weird combination of sort of God and also aliens or something. It's a very weird kind of set of beliefs, but they are going to come from the planet Clarion, and they are going to destroy the world on December the 22nd, something like that, at midnight. And so they've got all this cult. They're all gathering in this house, waiting for the world to be destroyed, and they're going to be taken up in the flying saucer, and they're going to be taken to the planet Clarion, and everyone else on Earth is going to be killed. And what's interesting about this cult is that some psychologists, academic psychologists, had found out about them, and some of the junior psychologists, the grad students, they'd joined the cult so they could watch what happened. So you've got these academics sort of quietly sort of observing and trying to take notes. Like, what is going to happen at midnight? Because obviously the flying saucer is not coming. So what happens when the flying saucer doesn't come? And it's kind of amazing. So midnight strikes, there's this deathly silence, and everyone's like, maybe the clock's wrong. There's a different clock in the kitchen. They go to the kitchen, the clock's different. So there's all there's these excuses at first. But then so some of the cult are really deep involved. So they have quit their jobs. They've walked away from their children, their spouses. They're all in. And others are more kind of a bit curious. They come to the cult meetings, but they haven't committed in the same way. And the theory that the psychologists have is that the ones who are totally committed, they're going to double down. Whereas the ones who were never committed, never that committed, when the whole thing's proved wrong, they'll kind of like, oh, whatever, walk away. But if you've already left your husband or your wife,
giving your money away,
you've given your money away, you sold your house, you've quit your job, and the aliens don't come. This is so shattering. You have to basically find a way to keep the story going and double down. And they did. So what happened when when by about 4 a.m, they were like, I guess the aliens haven't come. The cult leader, who was a woman called Dorothy Martin, suddenly was like, oh, I'm getting a message from the aliens. Mm-hmm. So she picks up this paper and she's like, the aliens are writing through me. And she's writing and with a message. And the message from the aliens is that because of the faith shown by these small group of people in that place, the Earth's been spared. Oh. The aliens are not going to come. And that's the point at which they go, we need to put out a press release. Like, are you kidding? Are you kidding me? Now you put out the press release? They they never really talked about their beliefs before the end of the world. But after they were proved completely wrong, like, we need to tell the newspapers about this. And that's this idea of doubling down on your beliefs if you hold them strongly enough. And I think that's the situation that Fisher was in. Like, he was so committed, he couldn't back away.
So, Mr. Carole, I hear you are a salesman.
Elite salesman, yes.
One of the best, they say?
I've got a little bit of experience in the game, yeah, I could say.
Done a few deals.
I bill.
What would your compliance team say about you?
They would say that I am always nagging them, and that essentially I have beef with compliance. I love the team. Compliance slows down all my deals because every time I get to the finish line, they've got to check documents, KYC, GDPR, and it's just a nightmare. It slows the deal down by like 2-3 weeks.
It's always on both sides as well, isn't it? Sometimes it can be block on the other side.
Exactly.
Well, that's where today's sponsor can help.
Indeed. Vanta helps companies of all sizes get secure and compliant fast, and they stay that way.
They do it by automating compliance with over 35 security and privacy frameworks like SOC 2, ISO 27001, and HIPAA.
Yeah, all of them. And this saves businesses so much time and money.
According to a recent IDC study, Vanta customers save over $500,000 a year in costs.
Not bad.
And they also help you complete security questionnaires up to 5 times faster, which is great because everybody hates filling out forms. If you're a business that needs to prove security and compliance, visit vanta.com/making money to sign up for a completely free demo today. Let's talk about this idea of cope. Call it, like changing the narrative to suit it. I thought it would have been funny if the aliens were like, "Oh, we're stuck in traffic." Or something like this. That's what your aliens would say. Yeah. So you said that like Fisher didn't change, Keynes did. Mm-hmm. You talked about index funds and the importance of those as an investment vehicle for the masses, and a lot of the what I firmly believe is that like a consistent investment approach through thick and thin into, say, like a globally diversified portfolio is probably a sensible investment approach. Not the best, not the worst, but it's likely the one that will get me to my end result. And it's likely that one that 99% of investors can kind of wrap their head around and participate in.
Yeah, I mean, I'd say it probably is the best, to be honest.
Okay, amazing.
I mean, obviously, if you know who's going to win the Grand National, then put all your money on that.
Yeah.
But if you don't actually have the ability to see into the future, then you're a globally diversified index fund, regular investments, don't mess.
Yeah.
That is probably the best any of us can do.
Well, I could concede that there might be people out there that can beat the market because they're like so into it. But I think that
Warren Buffett?
Yeah, Warren Buffett. But I would even argue over the last 20, 30 years, he is the market. He can't beat the market because he's so big, right?
Also, Warren Buffett, in his advice to his wife,
and to everyone else.
When I die, put the money into a Standard & Poor index fund.
Yeah, because he...
So even Warren Buffett is like, I wouldn't advise you to try to do what I do.
But that's the point. Like, it's like, the best outcome for the most people is the index because mechanics aren't Warren Buffett and they should be the Warren Buffett of mechanics. They should try and be world class in what they do every day, right? And rather than going, oh, I've now got to become world class in this field that takes a lifetime.
Yeah, but I would say, I mean, we could get deeper into this if you want. It's not just about, mechanics can't be Warren Buffett. It's the hedge funds can't be Warren Buffett. No, there are investment professionals whose entire job and who are paid enormous sums of money, the whole job is to pick the right stocks, and they can't do it.
Yeah.
And I mean, this has been well documented for many, many years that basically index funds will beat most professional stock pickers, most active funds, most hedge funds. And the ones who do beat the market, it's normally a fluke.
On a long enough timeline, it'll beat them all, pretty much, because they blow up or something goes wrong. There's only really Warren and a couple that checked out after a 20-year period or died.
Yeah.
Is it Simmons?
Yeah.
He died, basically, didn't he?
Yeah. But yeah, so it's not just a case of, you're not a professional, so you should invest in an index fund. Even the professionals do better if they invest in index funds.
I would argue that most professionals just track indexes now because they don't want to be seen to be underperforming. Yeah. They just want the assets under management.
And charge a bit extra.
Yeah.
But there's an amazing bit of maths about this. If you want So a colleague of mine at the FT once did this calculation. He said, imagine Warren Buffett. So, he's the greatest investor in history. He's got 50 years worth of investment performance. Imagine Warren Buffett was split into two. So you had Warren Buffett, the hedge fund, and Warren Buffett, the investor who is trusting the hedge fund with his money. And Warren Buffett, the hedge fund, charges what hedge funds usually charge, which is 2 and 20. So just, you can hit the red button
I
if
was
you
about
like.
to, but I was like, you're probably going to explain what 220 is.
So 2 and 20, go for it.
You love it.
So,
You can hit it as well.
so 2 is 2% a year, and 20 is 20% of any of your gains. So if your investment goes up 20%, you get 20% of that 20%, which is 4%. So you're paying the 4% plus you're getting the 2%. But you don't mind that because you got 20%. That's a pretty good return. You don't mind paying those fees. So total fees of 6% that would be, but you're still getting 14%, which is a fantastic gain. So that the idea is, well, imagine if you had Warren Buffett and he's charging hedge fund fees. And so you've got these two Warren Buffetts, and one of them is making Warren Buffett returns, but paying hedge fund fees, and the other is just gradually collecting in the hedge fund fees. And the question is, where is the money at the end of the 50 years? And the answer is, almost all of it is with hedge fund Buffett, because hedge fund Buffett is basically just slowly accumulating the money from charging, and then he's investing his own money, and he's not having to pay the fees on it. Whereas the retail investor who's getting a fantastic Warren Buffett style performance but paying the 2 and 20 fees, I mean, they're doing fine, but it's the hedge fund manager who's making all the money is the point of that. Like, even if your hedge fund manager is Warren Buffett, he's going to end up with all the money, not you. And I think that's the importance of that piece of maths.
Yeah, like a 1% fee with an average return over an investing timeline will take a quarter of your pot, just 1%. So when you get to 2%, they're taking majority, in fees.
Yeah, and by the way, I think this is true, if the fund falls one year, they don't give you 20%, they don't give you a discount, they don't give you the money back.
No, and they're still taking that 2%.
Yeah.
That 2% is the crippler, right? Because it's rain or shine, and it does rain, and they're still creaming off the top. They're kicking you while they're going down, basically.
And people think it's worth exploring. You said even 1%, it'll eat up a quarter of your portfolio over the course of your investment career. And I think people don't often follow the arithmetic of that. And I was just thinking about that as I was coming here. I was thinking about that point. It makes such a difference because if you imagine, you got some money, you put some money in a fund, and you're 25. So you put some money in a fund, you take 1%. Okay, then you're 26. Maybe put a bit more money in the fund. 1% comes off that, but another 1% comes off the first bit of cash, the cash you invested when you were 25. Now, when you're 27, you put some more money in. You pay 1% on that, but you also pay 1% on the stuff you invested when you were 26, and you pay 1% on the stuff you invested when you were 25. And by the time you're an old man like me, you've been paying the 1% on that first bit for 26, 27 years, and I'm not retired yet. So you're paying it over and over again. And sure, the stuff right at the end, you only pay the 1% once, but some of that stuff you've paid 1% again and again and again and again and again, and it can really, really add up. Huge amount.
Yeah. So I love the tangents we're going on, by the way. Don't stop, because I think your storytelling is amazing. But the point I was making about the indexes was that it's almost like a religion, and it sounds like you're sipping the Kool-Aid too, like, Zoltan, one of us. Yeah. Like you're part of the cult.
No, absolutely, absolutely, yeah.
But you said that Fisher's biggest issue was that he wasn't flexible and he didn't change, and Keynes did. So how do we cope with that? Like, what are we all just? Because basically index funds have existed since the 70s.
Yeah.
The dominant trend since the 70s has been declining real interest rates, and now reversing. American supremacy. Like, there's so many things that I could point to go, well, maybe that narrative is changing.
Yeah, maybe the narrative's changing. But I think that what I would say is, why would you expect it to change? Like, what is it? So people say,
it's just my luck.
It's an increasing market, or it's a declining market.
Yeah.
Like if it's a bull market, then of course index funds will beat active funds. But in a bear market, when the market's falling, then the active funds will beat the index funds. Why? Why is that? I don't understand why that would be. I've never had anybody clearly explain to me. I mean, I totally understand why index funds do well. And in a way, it's kind of obvious. I mean, they just are. If you average up all the active funds, then that's the index. That is the market, right? So of course, on average, it's going to do as well as the active funds on average, and their fees are lower. So after fees, it's going to do better. So that logic seems really, really strong. But I haven't seen a really strong logic. I've just seen a lot of special pleading as to why that should change. And I would accept that maybe there's a situation where the stock market's not the right place to invest, and maybe you should go into a bond index fund, or you should go to a commodities index fund, or maybe you should be investing in property. I could understand that's a logic that's not really what I do, but I could understand that might be the right thing to do.
Periods of outperformance for other asset classes.
Yeah.
So you're timing like asset classes.
I can see how that might be.
We
the
might
case.
get a period where gold does better than the stock market.
Yeah, exactly. And well, you do sometimes get a period where gold does better. But what I don't see is the fundamental thing of like, if you're investing in stocks, then I don't see why you would ever not want to choose an index fund
because of the fees
actives.
are certain, and you get that gain instantly. But the active will say that indexes have distorted the market to the point where, because of market capitalization weighted indexes, you're just pouring your money into the big seven, and they're now 25% of the total index. So what you're actually doing is you're just buying companies that are overvalued, whereas what we do is we will find opportunities within it that are fairly valued. And,
well, they haven't done it yet.
No. I mean, I'm not that. I'm like anti-active. I'm just trying to throw the arguments.
Yeah,
at you.
I mean, there's a couple of ways to sort of interpret what that argument that you've just relayed. So one is it's a bad investment to get into index funds. Because they're too concentrated. Maybe that's true. If you're worried about that, there are kind of equal weight index funds. So you can basically say, do you want to hit the button?
No. We are very familiar with.
I could hit the button.
You want to hit the button?
So the idea is, say it's the S&P 500, so the top 500 companies in the United States. An equal weight fund would just say, right, well, $500, $1 in each of those companies, whereas a more traditional index fund would say, well, NVIDIA's a really valuable company, so we put more of your $500 in NVIDIA and in Apple and in Google and so on, in the big ones. I mean, I'm not hugely convinced, but there's a separate argument that says, in the end, even though it's a good idea as an investor, it's a bad idea for the world, for everyone to be in passive investing.
Capital properly.
And that argument, I think, has got some merit, although I would say it's not my problem to set prices in the market. Yeah. But I think at the moment it's about 50-50. So about half the money in the market, I think, I could be out of date.
This is a funds, right?
Yeah. So about half the money.
51% is passive and it's tipped. But there's a lot of people that still hold individual companies. So there's probably a much bigger component of active. So if you call active anyone who picks a stock.
Yeah. So the question is, at what point do you have so many people who are just saying, I just want to buy the market, and so few people who are actually picking stocks that there's no information in the market anymore. So the fear is, if you imagine Joe Stiglitz, Nobel Prize-winning economist, once wrote a paper about this. If you imagine a situation where literally nobody picks stocks, everybody just goes, I just want to buy the market. At that point, there's no reason to believe that any of the prices of any of these companies are fair. And if you actually came along and did a bit of fundamental analysis and said, actually, what are the profits of these companies looking like? What are the growth prospects? Which is the best deal? You get fantastic bargains. So if you were in that situation where literally nobody was a stock picker, you could make a killing being a stock picker.
The opportunity swings the other way.
Yeah.
Exactly.
So the question is, we're at 50-50, as you say, ish. Does that create opportunities for the stock pickers? I suspect not. This is just an instinct based on economic theory, not based on any data. I think, I don't know, 10% of people, 5% of people, you don't need that many, because 5% of investors is still a lot of money. You only need a few people setting the price, doing the stock picking, and everyone else can go, you know what, you guys are so clever, you do it, and I'll
have
just buy the index.
95% passive.
I'm speculating, but the point is when you go into Tesco or Sainsbury's, the prices of those products reflect the cost of the product, and they reflect the competition from other stores. So I go into Tesco, did I check what the price was in Sainsbury's? Did I check what the Asda price was? Did I check what the price was in M&S? Generally, no, just go into Tesco. It's fine. There are some people who are checking. Like I wrote a column once about the idea of their grandmother who's in front of you in the checkout queue, and you're like, I can't believe this woman is taking so long to pay for her groceries and she's got all these vouchers and all. But be thankful to her because she's the one.
She's the active investor.
She's the active investor. She's keeping them honest. And as long as you've got a few people who are actually really, really keenly comparing the prices, then you don't need to bother. And the same basic thing, I think, applies in the stock market. You need some, you don't need everyone.
I love the fact that you knew what the equal weighting was. It was like a proud moment.
I've come a long way, buddy. I've come a long way.
Yes, mate. Don't need the buzzer. So, okay, I want to talk about, because I think the active guys, my theory on this, like, is it's not well thought out, but I think what's actually happened is index funds have just allowed people to participate in the market where they're not getting ripped off. Yeah. Whereas before it was like through a broker who was charging you a fee, and basically like a lot of the return that's generated is just the saving in fees, like you pointed out. And we now have a position where I can explain to people on my YouTube channel who would never have invested the simplicity of these broad indexes, and they'll participate, and that's can only be a good thing. And I think traditional finance is just bitching because they're like, we should be getting 2% of that, and we're not. Any day now it's going to turn, and the 1 year that active beats passive, they're all going to be like, look, even though the record is 50-0.
There is a lot of money to be made convincing people
Kathy Wood
to pay fees.
Did great at it,
But when there's a lot of money to be made convincing you to pay fees, I'm like, maybe you shouldn't be taking these guys too seriously.
Paul Samuelson, so he was the guy behind the index fund theory, and we'll talk about the story in a sec, but he said that markets were efficient as well. Is that correct?
He did.
Do you think that they are then, based on what we're talking about there, where we're all like, highly inefficient?
I think they are nearly efficient. I think it's useful to think of them as efficient. So we should probably remind people.
Take it home with you.
You're taking this buzzer out of my cold, dead hands. So just to remind people what we mean by efficient markets. So efficient markets, basically, there's no systematic advantage to be gained. There's no obvious bargains. So whatever the markets might go up, they might go down, but they won't do that in a predictable way. There's no kind of obvious thing like, oh, markets always go up on Monday, or markets always go up in December, or like this company is clearly massively undervalued and you could just buy it for a song. Because the market knows all of that, and the market's already dealt with all of that. And so what's left is the surprise. And that's where the idea of the random walk comes from. So it's just like random news moves the markets up and down.
Like
but it could be they don't have to be black swans, just like anything that wasn't predicted. Small stuff, big stuff.
Tariffs.
Yeah.
Bombing Iran.
Anything. Yeah. Could be anything. Yeah. And a lot of it's small stuff, and a lot of it's like industry specific stuff. Because remember, it's not the market, it's 500 companies in the S&P 500, and they've all got their own little stories going on.
No one could have foreseen the Boeing plane, like coming down, and that affects the share price, and then you own the index. You're like, why am I down a fraction of a percent?
Yeah, it's because you got 1/500th of Boeing, or 1/500th of your money is in Boeing. So that's the idea of the efficient markets hypothesis, and it's not quite right. There are systematic errors that the market makes. There are times where there are measures that fairly reliably suggest the market is overvalued, and in the past they've always basically said you should probably be buying less, and other measures that suggest the market's undervalued. And there are systematic effects like small companies seem to be better value than big companies, and things like January I think does quite well and August does badly. And sometimes these anomalies are identified and they kind of go away, and sometimes they seem to persist. But the point is not that markets are absolutely perfect, are absolutely efficient, but they're probably efficient enough that you should act like they're efficient. And what does that mean? Well, first of all, it means buy an index fund, as we've discussed. If you think markets are efficient, buy an index fund. If you think they're massively inefficient, then do your analysis and be clever and pick the right stock. So that's the first thing. Second thing is you get the sort of the no free lunch idea. So, for example, just before the financial crisis, 2007, 2008, you had these financial products that were being sold, not to retail investors, but to professional investors. So like bank to bank or bank to pension fund. So they're basically saying, oh, this product will pay 10%, like a really good rate of return. And it's incredibly safe. We've done all the modeling. It's super safe and it'll pay 10%. Efficient markets hypothesis says no. If it's paying 10%, it's not safe. Turns out it wasn't safe.
Yeah.
So I think I'm not saying the markets are always efficient, but I am saying you will tend to make the right kind of decision if you act as though they are.
And you'd have to be working pretty hard to spot the inefficiency because broadly they're efficient.
Very hard, very hard.
What I think a good message is to people is if your mate down the pub is telling you to buy Tesla because electric cars are the future, the market already knows.
What does he know? What does your mate know?
Yeah. Why has he spotted the inefficiency in the market?
Yeah.
Because I think these are the narratives that sucker people in.
Yeah.
They hear AI and they go, oh, AI is the future. The market knows this potentially, or any narrative that you hold off a common person, the market's priced it in and weighed it.
I mean, my little pet theory is that most people don't understand how rich people get rich. Why would they? Most people aren't rich. Most people haven't spent a long time hanging out with rich people, and therefore they assume that rich people get rich because of some kind of some sort of corruption, some sort of tip they got.
They're smarter inside advice.
Somebody told them something, and then so you've got this view of that's where real money comes from. Is somebody whispers something to you, and you take advantage of it, and that's how you get rich. But that is not how most rich people get rich. Rich people get rich through being incredibly good at investment banking, or being incredibly good at programming, or setting up a company, or inheriting a lot of money, or it's not because they got this great tip. Elon Musk did not become the richest man in the world because someone gave him a great tip about some stock. That's not how it works.
No, and most people are just parking money in the market, right? The money's already in earned. The people who have loads of money in the market probably put loads of money into the market, or they lived as long as Warren Buffett has and invested since the age of 11.
Yeah.
How many people are fabulously wealthy solely off investing in the stock market?
Yeah.
To the point where they're billionaires. I think there's probably a handful, right?
Yeah, not many. That's not the normal way. When you got money, as you say, you park it in the market and it snowballs. But that's not normal. That's not how Bill Gates got rich. That's not how Elon Musk got rich. It's not like how Larry Ellison, the head of Oracle, got rich. It's not how the heads of LVMH got rich. All these billionaires, they were making money in another way. It's Buffett's the one, and there are a couple of others like Jim Simmons, who you mentioned. It's not usually through clever investment savvy.
Can we talk a little bit about the index fund then? Because I think it's an interesting story.
Yeah, we just celebrated 50 years.
Yeah.
So,
in the church.
So the idea, or at least part of the idea, came from Paul Samuelson, who we mentioned, who was one of the first economists to get the Nobel Memorial Prize in economics. He was the real star of post-war economics. He wrote this super famous textbook that everybody had. He advised John F. Kennedy. He really contributed to the mathematization of economics and bringing ideas in from physics to sort of make economics more sort of mathematically rigorous, which maybe is a good thing, maybe isn't, but very, very influential. But he also had this kind of brainstorm that if the market is efficient, then stock picking doesn't work. And if stock picking doesn't work, maybe you should just buy the index. And he published this essay where it was called a challenge to judgment. Basically said, if you stock pickers are so good, prove that you can beat the index. Let's see. And if you can't, maybe you should take up plumbing or something instead.
Something more useful.
Yeah. I mean, we should say, in order to have that insight, first of all, someone needs to invent the index, and that had happened. That was Dow, I think, of Dow Jones fame, and that had been like 50 years before, or maybe more.
And that was just a benchmark.
It was a benchmark, so that you could. I mean, he also founded the Wall Street Journal, and one of the things you could do then is to print a news story that says the market went up yesterday.
Because he invented the market.
He invented the Dow Jones Industrial Average, which was 30 stocks. I mean, it's a slightly weird benchmark. It's not how you would do an index today, but just that insight of I guess we could talk about like how the market is doing. But previously, you would have to say, well, how are stocks in JP Morgan doing, or Pullman, or Exxon? Well, it wouldn't have been Exxon back then; it would have been Standard Oil. But that's an interesting moment. Anyway, with the idea that you have the index that measures the performance of the market, at that point, you get to the situation where, well, we could just create a product that tracks the index. And John Bogle, who is the creator of the index fund, read Samuelson's article, and he'd already set up a fund management company, and he was trying to work out what funds to launch. And he thought, well, I guess I'll launch an index fund. The interesting thing is, it was a total flop at first.
No one liked it.
No one liked it.
The folly of Bogle.
Yeah, Bogle's folly. Yeah, and partly it was basically he's going, do you want me to absolutely guarantee completely mediocre performance? People are like, hell no, this is America.
No, it's not sexy.
Yeah, I want top 1%. We all want top 1%.
Yeah.
Well, you're not all going to get top 1%. But in the end, it caught on, and slowly, and it has been a really slow build. Vanguard and other companies selling index funds are now, as you say, about 50% of the market. And they've saved investors, I think, literally half a trillion in fees is one estimate. Maybe it's $1 trillion by now. That estimate's a few years old. And partly directly because by charging lower fees, but also because it forced the active guys to charge less as well in competition. So it's
one of the greatest inventions of all time in terms of like.
Samuelson said it's like the invention of the wheel or wine or cheese. The index.
Those are his three things. Like no sliced bread. He just wants the cheese and wine and the wheel.
Sliced bread, is it that good? Cheese and wine. Cheese and wine's amazing.
They say the greatest thing since sliced bread, don't they? That's the saying.
I know,
right?
but I think that's supposed to be funny because
what are you sticking your cheese?
Bread's not.
What are you sticking your cheese on? Slice of bread, mate.
I know, but I don't know. I need to come back and we need to have a further conversation about bread, but that's another subject.
Yeah. No, to be fair, sliced bread is not the best bread, is it?
Yeah.
There's the best breads come whole.
Full loaf.
I think so.
So the one thing that I get from all of your work and everything that you do is that actually the answers are simple, but that feels really counterintuitive. Like your book presents like how to make the world add up.
Yeah.
And you present like 10 simple things, and you were talking about index investing. It's actually pretty simple, and all this complicatedness that people, if that's a word, that people are engaged. Complexity.
Yeah.
There we go. The shenanigans that they're engaging in, ignore all of that.
Yeah.
Is it really that simple?
Well, the world is complicated for sure. The world is not a simple place. And in fact, one of my books is called Adapt, and it's all about trial and error and making mistakes and learning from mistakes. And another of my books is called Messy, which is just about how like the world just doesn't fit into neat categories. So I'm not saying the world's simple, but often when you're faced with a complicated world, fairly simple advice works. And I was really struck when I was working on this book, How to Make the World Add Up. So it's a book about how to think clearly about data. You can buy it. So I was trying to.
You can buy it.
You can buy it right now.
Yeah. So it's such good value. Where was I? So for years and years and years, I've been presenting this BBC show called More or Less, which is helping people understand numbers. And for years, I've been resisting writing a book about numbers because I was like, so many books out there. I don't think I have anything to add. And in the end, I realized, oh no, I do have something to say. And it's partly a defense of numbers because so much of what we do is debunking dodgy statistics. I'm like, actually, they're really important. And there are a lot of really trustworthy numbers in the world. So don't just think that thinking clearly about numbers is just disbelieving numbers, because sometimes the numbers are telling you the truth. But the other thing that I wanted to do was give people psychologically relevant advice. So I can tell you about causation and correlation. I can give you all kinds of technical advice. But often the reason that people make mistakes is not because of a lack of technical skill. It's because, their emotions get the better of them. So a lot of the advice in the book is about controlling your emotions.
Awesome.
But one of the inspirations for the book gives 10 rules. If I was boiling it down, I'd give 3. But I was inspired by a guy called Harold Pollack, who wrote a book, you probably know, Finance on an Index Card. Mm. And his idea was actually all the financial advice you need, you can write on a 3x5 inch card, which isn't quite true, but it's not true, is it? There's a lot of insight in.
Spend less than you earn, invest the rest in a global index fund inside of a tax-efficient account, rinse, repeat until you retire.
It's about that, isn't it?
Yeah.
It's about that. But I think in the modern world, you might want a bit more advice about dodging scams and not. But,
don't get scammed.
But but the point is,
that'll do. Got that line in there.
Write that down.
Job done.
Yeah, write that down the side. You'll be fine. But the point is, that might not be all the advice you need, but that's probably like 90% of the benefit is the advice on that card. And I felt the same way with How to Make the World Add Up. Like, I could probably write statistical advice on an index card, and the book's there just to elaborate a bit. But actually, the advice that I give people is pretty simple. And I wrote a version of this book for 10-year-olds. And so I've given this advice to 10-year-olds, and I've given this advice to the membership of the Royal Statistical Society, who's a bunch of people with PhDs and professorships in statistics. And basically, I said the same thing to them.
Just bigger words in the bigger book.
Yeah, it's the same basic advice. And it's about how can you not fool yourself? How can you not be led astray by your emotions? And actually, the story of Fisher and Keynes is in the book, because that's two incredibly smart people, one of whom was totally undone because he just fell in love with his own idea.
There was one, Stancheva, is that how you say the name?
Yes, definitely Stancheva, I think.
Stancheva. So this was interesting in terms of like zero-sum thinking, and like if you're talking about being fooled by yourself, I think this one is quite relevant to the political landscape that we operate in today. Yeah. So you said something interesting. You said 20 years ago, economists were rock stars because of the release of free economics. Yeah. And then they've become really kind of unpopular, almost laughed at. Like, you know, people are like, oh, they do the opposite of what the economists would say is sensible. Yeah. And the research that she's done is focused on people and kind of their belief systems that they have. Could you talk about?
Yeah, I mean, that's one of many things that she does. And she's won a big prize.
She's very young as well.
She's
39.
Yeah, so she's won a big prize, the Bates Clark Medal, which Steve Levitt, the free economics guy, also won. And it's the best American-based economist under the age of 40. So yeah, you got to be.
Just about got it.
You got to be.
We could get it to.
We got some out of time.
You can do it. You got time. But they mostly give it to people in the late 30s for obvious reasons. But so one of the things she does is she interviews people about their feelings and about their opinions. And so one of the things she's been trying to understand is what she calls zero-sum thinking, which I think is a really important idea. And zero-sum is basically like, where does money come from? Where does success come from? Well, from somebody else. Like, I can't get money unless, I can't make money unless you lose money. I can't win unless you lose. And that sort of thinking is, I think, really prevalent in politics today. And so it gets you thinking about this idea of like, oh, the immigrants are causing the problem. We've not got the jobs we want because of the immigrants. Or, oh, it's the Chinese.
Or the wealthy,
or the boomers.
I mean, you can pick your group. There are different groups to blame. And I'm not saying that nobody in the world deserves to be blamed for anything. I mean, people do bad things, and if they do bad things, then that should be identified. But the point is, that sort of zero-sum thinking gets you to a very polarized world of kind of when you're like, okay, we've got this amount of cake, and like anything you get, I don't get. So I just want to maximize how much of this cake I get. Whereas a natural economist's way of thinking about the world is, well, there's always more cake. People are always baking more cakes. We need to figure out better ways to bake cakes, bigger cakes, tastier cakes, healthier cakes. And so the cake is always getting bigger. The cake is always getting better. And that's a different way of viewing the world, but it's often more accurate. Not always more accurate, but it's often more accurate. So with trade, for example, the idea that we're trading with China and they give us stuff and we give them money, and that's bad. I'm like, that's not bad. That's good for them. That's good for us. That's fine. That's not a problem. So really interesting to see that thing, the spread of that thinking. And what Stancheva found was that zero-sum thinking is particularly common among young people, which I think is probably not a surprise. And I don't think it's because young people are inherently like that. I think it's because of the world they've grown up in. So if you're 70 years old, you can remember a time when the economy is booming and booming and booming. You can remember a time when you could buy your own house and it'd be fine, and there was a good job. People who are younger, productivity growth's been much less, and we've not built enough houses. And so your perception that you can't afford a house unless somebody else is too poor to outbid you, that's not wrong.
Or that your parents have to die for you to get a house. It's literally a zero sum.
Yeah, so we've helped to create this world where actually the zero sum thinking, maybe that is correct. But I think the answer to that is, well, maybe we need to get back to creating a world where everyone can win, because it is possible.
I think one thing I've learned from the podcast that a lot of economists kind of leave out, you mentioned earlier, is like so much of investing, apart from your like little index card, is human like behavior or financial like human behavior. And that's one of the main things I've had to work on myself. Not just once you learn the fundamentals and invest here, you've actually got to work on your habits, your flaws, and like your inner voice and your emotions.
I think you're absolutely right. You can do incredibly well by following basic tips, save money, put it in an index fund, all of that kind of stuff. But if you are buying shoes that you don't want, or more generally, if you are not spending your money mindfully and you're consistently spending money and going, I just wish I hadn't done that. I didn't really enjoy that. And now the money's gone. If that's happening, that's incredibly important. And that's not really something that an economist is going to be able to help you with.
The research from the lady we just spoke about, she found that zero-sum thinking was more prevalent in cities, which makes no sense because these are areas where collaboration, cooperation, it's like people come together in a city to collaborate. The strength of a city is the unity of people. So for it then people to think this is a zero-sum game is a bit backwards, right?
Well, I can tell you've lived up north, mate. I don't know about too much collaboration in London, man. Collaborating, robbing you.
No, but they are collaborating. Yeah.
Gang will collaborate.
Collaborate my shoes.
I will collaborate your watch, Damien.
It's not the shoes. He didn't want to pay. He
didn't want them anyway.
Yeah, he was moaning about this pair on the podcast last week.
I'll have them.
But that's why you need to grab the data, right? Because I could tell you a different story. I could say, no, it absolutely makes sense that people think zero sum in cities because you're constantly competing for scarce space, on the underground, on the bus,
parking spaces,
people are getting in your way, and in particular the housing market. Like you're trying to rent a house, you're trying to buy a house,
in the same flat as you.
and the estate agent wants to make sure you know it, right? So I could totally tell a story about why zero-sum thinking definitely, that's going to be prevalent in cities. But you can tell your story, which also makes sense. You got to go and ask people. You got to get the data. So that's why economics has moved past people sitting around in armchairs thinking really hard and actually going out and asking people and getting the data. It's important.
You said you could boil down the 10 lessons in this book to 3. So what are they?
So they all begin with C. Number 1, be calm. So take a leaf out of Darth Vader's book. So search your feelings. Right? So when you see a statistical claim, you're often going to see it in an emotional environment on social media, on the front page of a newspaper or website, and it's designed to get you angry or upset or excited or afraid. It's designed to provoke an emotional reaction, or someone's trying to sell you something. They want to get you greedy. Just notice how you're feeling. It's like, I'm really excited about that, or I'm really frightened. And once you've noticed how you're feeling, you go back and you think about it again. It's totally different kind of head you've got on, and the claim will often look different. So be calm. Number 2 is get context. So context could be all kinds of things, but it's often like, where did the number come from? Is it going up or down? Like, what was the number 5 years ago or 10 years ago? What's a useful comparison? Like, you're making this claim about this investment product, but if I compared another investment product, would that be different? We say this about Britain. Well, what's the situation in France? So those sorts of context, those sorts of kind of pieces of information, those comparisons, really important context. It doesn't matter how good you are at numbers. If you don't have the context, you just don't understand what you're looking at. And then the third one is curiosity, which I think we've been curious today, haven't we? Curiosity is just about like going deeper, not constantly trying to prove a point, not trying to win an argument or justify some pre-existing belief, but going, oh, that's interesting. I didn't expect that. I want to know more. I want to understand more. I want to know what's going on underneath that. And that might seem really obvious, but so often we use ideas, we use data, we use claims as weapons in arguments rather than as kind of a starting point for an exploration of the world. So calm, context, curiosity. There you go. That's your 3.
That's the line.
I thought you were going to do that, but yeah.
It's the last one of the day. I'm done in now. I need to go and eat and just chill out. But I really enjoyed it. I didn't want it to stop because he's had a great way of kind of making things seem simple, didn't he?
One of the most interesting economists I've ever met.
You've met a few now as well.
I know. I was perspiring a little bit, but it was really, really good.
I'm not sure what that's got to do with it, mate. But just your sweaty self.
Heat, mate. It's hot out here.
Yeah, clammy is the 4th C, mate. That's you.
Yeah, the 3 C's are very important.
I also like that he pointed out that, he was very bullish on the whole index thing. And I like that. I like when guests are part of the religion.
I like that he simplified investing generally.
Yeah, if you're looking to get into the index fund approach that we discussed there, I've made a completely free course about index fund investing for beginners, and hopefully it's nice and simple, takes a couple of hours and should take you from A to Z, or A to C, or A to T. Whatever it is, we'll leave a link in the description for you so you can check it out.